Good afternoon, everyone. Welcome to the PJM State of the Market webinar. We're going to be kicking this off in about 1 minute. We're just waiting for folks to filter in and find their seats. So we'll kick off at about in about 60 seconds here. Okay, let's get the show started. There's still some folks filtering in. We're just going to be doing a brief introduction as we get going here. I'm Nick Spire. I'm the Chief Executive Officer of SYSO. It's really great to have you join us this afternoon. A quick agenda for the day. We're going to be doing a very brief overview of just like who we are and what it is we do here. And then we're going to be jumping into specifically what is going on in PJM. So talking about capacity market changes and updates and what we think is going to be coming over the next several years. We're going to hit on the regulation market redesign. And then finally, almost finally, we're going to be hitting the state and programs for storage because there's a lot of these coming out. And we'll be talking about what that means for both storage development, but also how those are going to be interchanging and interplay with PJM market rules. Finally, at the end, we're going to have a Q&A session. And Brian is going to drop into the chat. We've shared the link in advance of the webinar. Most of you should have received this in your email, but if you haven't, Brian's going to drop a question form into the chat for this meeting. And if anything comes up, I don't believe that's going to be able to stay up there the entire meeting. So if you would just want to grab that link now, and that way you'll have it there if you have any questions. We'll put it up again towards the end of the prepared content, so that anybody that has any questions that come up over the course of the webinar will have an opportunity to put those in. Then we've had some great questions coming in advance, so that's been we're going to have a lot to talk about clearly. All right, so SYSO, this isn't going to be an infomercial. We really wanted to just get to the content here. But we are a market operation service provider. We are very busy in New England, New York ISO, PJM, MISO, ERCOT, CAISO, SPP, ISO, and regulated market territories. We have about 270-ish assets under management, representing over 4 gigawatts of capacity in the US and Canada. So we do all market registration. We do 24/7 market operations through our NERC SIP, which is pictured behind me. Dan's actually in front of it today. We do optimization and scheduling, reporting and settlement. Specific to PJM, we've been very busy for a while, and it seems to be getting busier, specifically around real-time telemetry, AI telemetry, real-time telemetry, 24/7 control room dispatch, optimization. We're active in all the main revenue streams for PJM market participation. And we're working with solar, storage, wind, and solar plus storage assets, front and behind the meter in PJM, and have been for some time. So I'm going to get off mic momentarily and hand this over to Dan Curran. And then he'll hand it off to Doug Matheson. Dan's our Chief Strategy Officer. He's been a core part of our leadership team for some time now, and previously cut his teeth at Enernoc, SunPower, and NRG. He did have a cup of coffee outside of the energy business, but we were fortunate enough to lure him back in. And then Doug Matheson is our Senior Director of Energy Markets, heads up all market participation activity for all of the Northeastern markets, so PJM, New York, ISO, New England. Long career at Enernoc, into NLX, and managed over 2 gigawatts of PJM capacity over there during his career. So a long track record of experience in those markets. So you guys are going to be hearing from some of the best minds in the business today on this. And with that, I will quietly get off mic and hand this over to Dan.
Great. Thanks, Nick. And thanks to everyone who's joining us today. We're excited to be talking about some of the key developments in the PJM market. So we are going to be going kind of pretty deep into some of the fine details of PJM and how it operates and how it's going to be changing. But before we do that, I wanted to start with just some of the basics. We've got a pretty big audience today. I know some of our audience members might be new to PJM. So I just want to kind of start with some high-level information. So first thing you should know about PJM if you're new to this market is this is the largest deregulated power market in North America, right? And so you can look at it from a variety of different measures, whether it's installed generation capacity, peak load, annual consumption. PJM is the largest market in the country. It has been for some time, and it will continue to be, even with the load growth that we're expecting to see, which we'll talk about in a little bit. PJM will be the largest power market in the country. In terms of how PJM is structured, so the market is broken into 3 core components, very similar to kind of other FERC jurisdictional markets. So in the energy market, day ahead and real time, there's nothing particularly novel about PJM when it comes to the energy market, other than the size, the amount of energy that's transacted, the liquidity of trading, the amount of offtake that resides in the PJM footprint. Ancillary services, again, fairly standard. The key thing to note is that the regulation market is going through a pretty significant overhaul, and Doug's going to be talking about that during kind of the second half of the webinar, and talking about how those changes will impact storage in particular. And then the last core component is the capacity market, which is called the RPM, or the reliability pricing model. This is the part of the market that's been in the news the most recently. It's courted a lot of controversy. It's gained a lot of notoriety. And so we'll talk about this probably more so than any other part of the market. But this is a 3-year forward market where PJM is procuring capacity in advance of a delivery year. So we'll talk about that a fair amount during this webinar today. The other core part of the PJM market that I'm sure kind of most everyone on this call is familiar with is the interconnection queue, right? If you think about what's been in the news, what's been gaining PJM notoriety here, it's their interconnection queue. And back in 2022, the queue had gotten so large and it was moving so slowly that PJM took a fairly kind of drastic and unprecedented step in that they paused the interconnection queue for all new applications through 2026, right? And so we've been living through that pause for several years now. Doug's going to talk about how sort of the thaw and that freeze is just around the corner. But no new projects have been able to come into the market, which has created an issue in terms of new supply, and we'll talk about that in just a minute. But PJM sort of wastes no opportunity to highlight that there are upwards of 50 gigawatts of projects that have cleared the interconnection queue in the past few years, but that still haven't been built. And this is due to permitting, supply chain, financing issues that folks on this call are very familiar with. But PJM's point that they like to remind everyone is it's more than just the interconnection queue that's preventing projects from getting built. But at the end of the day, PJM is facing a lack of supply, and we'll kind of talk through that. So if we could jump to the next slide, I wanted to just double click briefly on the capacity market because we're going to be talking about that a fair amount. So I mentioned this is a forward capacity market, and it really revolves around this idea of a delivery year. So a delivery year in PJM runs from June through May. So we're currently in the 2025-2026 delivery year. Next year will be the 26-27 delivery year, and so on. So it spans 2 calendar years. And typically, the standard timeline is that 3 years before the start of a delivery year, PJM conducts what's called a base residual auction, or a BRA. And that's where they're procuring generation, either existing generation that's built, or because it's a forward market, planned generation that plans to be built prior to the delivery year. And they're trying to meet both their peak demand forecast and a reserve margin on top of that. And so in between the BRA and the delivery year, there are these 3 incremental auctions where if you took on a capacity commitment as a generator, or if you failed to take on a commitment, you can adjust that up or down in one of these incremental auctions. And PJM can also adjust the amount of supply they want to procure as their forecast changes between the BRA and the delivery year. So that's kind of the basic design of the capacity market and the timeline, how it works. If we jump to the next slide, PJM is currently in an accelerated market timeline, and it's been this way actually for some time now. Over the past decade, there have been multiple significant rule changes to the PJM capacity market. I won't even attempt to get into all of them, but when these changes have been proposed, PJM has had to have extended stakeholder processes. They've had to file with FERC and potentially deal with pushback from FERC. But the upshot is all of these changes to the market and the time that it takes to implement them and get them approved by FERC have led to delays. So BRAs have been delayed by upwards of a year or even more than that. And because of that, there's sort of been a chain reaction where if PJM delays one auction, they end up having to delay the subsequent auction and so on. So that has led to these accelerated timelines that we're currently in. If we look at the bottom of the chart here, we're looking at the 2030-31 delivery year. So what I have laid out there is the same as what I showed on this past slide. That's the standard auction timeline. The BRA is being held 3 years prior to the delivery year, and there are 3 incremental auctions occurring between those 2 time periods. But if we jump to the top, the 26-27 delivery year timeframe, well, that's much more condensed. So the BRA for that delivery year just happened a few months ago, and we're going to jump into those results in just a second. But you can see that that auction occurred just 1 year prior to the start of the delivery year, which will begin in June of 26. And there's only 1 incremental auction between the BRA and the delivery year. So over the course of the next few years, that timeline, that 1 year period is going to start to expand. And by the time we get to 2030-31, presumably we'll be back on track to the standard 3-year timeline. Now that's barring any significant, rule changes that PJM might put in between now and then. The last thing I want to call out here for folks is if you look in the top left, kind of at that BRA timeline, and you follow the line diagonally down to the right, you'll see that for the next few years, every 6 months, there will be a new BRA that's being held. So the standard way that this should work is that there's a BRA once a year. There will be a BRA every 6 months for the next several years. And I flag that for folks because if you're new to this market, if you've got a project in development that's trying to clear into the RPM while it's a planned project, if you've got a existing project that's just gone COD and now is subject to must offer requirements for the first time, there's going to be a lot to keep on top of, right? Every 6 months there'll be a BRA, and even before that, there will be things like the NOI, the notice of intent qualification window. There'll be attestations you need to file related to things like the MOPR and the MSOC, and we won't get into all those details, but the point is there is a lot to keep tabs on, particularly in this accelerated timeline. So, make sure that if you're new to this market that you're keeping on top of all of these deadlines because there will be many of them. So if we can jump to the next slide and we can go one further, I'd like to kind of, take the next few minutes and recap the BRA that just happened a couple of months ago for the 26-27 delivery year. So the short story here is, prices were sky high, just like the last auction, and in fact, they were even higher. So if we look at this chart in the top left, this is showing us PJM capacity prices over the past decade. And the units on the left are dollars per megawatt day. That is how both PJM and MISO price their capacity market. And if we look at the first few years, prices were in the, say $100 to $150 per megawatt day. That's what you might call like a quote unquote healthy capacity price, not too high, not too low. PJM's happy with prices like this. But then in the ensuing years, prices started to decline. And in fact, prices got well below $50 for the 23-24, 24-25 delivery years. So that, in theory, would indicate a glut of supply, and it's not sending the market a signal that we need to build new generation. But during this time period, PJM was publicly wringing their hands, and they were raising the red flag to say that there was an impending supply-demand crunch coming just around the corner. They could see resource retirements. They knew from the interconnection queue and the pause queue that not enough supply was going to be built, and they were rolling out a new accreditation system, which I'll talk about in a second. And lo and behold, PJM's kind of warnings came true. And in the 25-26 BRA, prices jumped up to the highest they had ever been, $270 per megawatt day for the entire market. And a couple of regions in Virginia and Maryland actually jumped above $400 per megawatt day. This year, prices were 20% higher than that, so $330 across the entire market. And it's really the same story as last year, right? It comes down to supply and demand. But if you double click into that, first of all, new generation is not being built, right? So we talked about both the queue and projects, can't enter the queue. And so there aren't enough projects coming into the queue. And even the projects that are coming out of the queue, as PJM is stating, aren't getting built fast enough. So we have a lack of new supply, but then existing supply is leaving the market. So there have been significant resource retirements, particularly from thermal assets over the past few years, coal, oil, natural gas. Some of that has to do just to the resource age, but a lot of it has to do with the economics in the energy market and these resources just not being able to pencil and sustain operations. On top of that, PJM put in place a new accreditation system over the past few years using a methodology called ELCC. We could do an entire webinar on that, and I won't try to go deep into that. But the idea being, it's a new way to basically qualify and derate nameplate capacity, looking at how much reliability does a given generation class provide to the system during peak hours, during scarce hours. And so they've derated their fleet, and in particular, resources that are being built, wind, solar, storage, receive a relatively lower accreditation than the resources that are retiring, coal, oil, and natural gas. So that's exacerbating this supply-demand dynamic that we're seeing with new generation and retirements. And then the other 800-pound gorilla that PJM is dealing with is load growth, right? So I'm not going to, be sharing anything, that folks don't already know about this paradigm shift that we're dealing with in the industry with load growth from data centers and artificial intelligence. But the thing you should know about when it comes to PJM is that it is going to be acutely impacted by load growth, really more so than any part of the country, and at least when it comes to data centers. And the reason for that is that PJM has multiple large data center hubs in its footprint. And most notably, Northern Virginia Data Center Alley, that's the largest data center hub in the country and frankly the world. And so those hubs are going to see very significant load growth. You can see PJM was anticipating a 6 gigawatt load growth just for this delivery year period. So this is a perfect storm on the supply demand side of the equation here. So if we can jump to the next slide, I'm saying this is a perfect storm for supply and demand. That's why these prices are going so high. But the prices could have been even higher. Were it not for a cap on the PJM capacity price for both this most recent auction, 26-27, and the next auction, 27-28. And people can disagree with this, but the rationale was everyone agrees that we need new supply. And if you want to incentivize new supply, there should be a healthy high price. But there was a record high price in 25-26, and there was almost no new generation coming into the capacity market, which we'll kind of look at in just a second. And so, it sort of points to that there are issues other than price that are preventing projects from being built. And that if the market is allowed to just send an even higher price signal, effectively that would amount to kind of price gouging of ratepayers. Reasonable people can disagree on that, but that was the rationale. So there's been this price cap in place, and it binded for this auction. Were that price cap not in place, PJM did an analysis and showed prices would have been 20% higher than they cleared. So they increased from last year by 20%, plus or minus. There would have been an additional 20% higher without the price cap. So that cap will be in place for 27-28. It's set to expire after that. But the political pressure that PJM is facing is not going away. Governor Shapiro just earlier this week was making noise about potentially having Pennsylvania leave the PJM market, which TBD on kind of how serious that is. But PJM is under significant political pressure, from both governors of red states and blue states to really fix this issue with getting new supply on it. If we jump to the next slide, there was one kind of silver lining for PJM in this auction, in that new generation finally started to grow. So if we look on the left here, those dark blue bars, that is new generation coming into the PJM capacity market over the past, say, 10 years. And it's, it's volatile, goes up and down, but the trend is clear. There's been a decline in new generation entering the market. And if you look at last year, 25, 26, record high prices and almost no new generation came into the market. And that's really kind of the rationale for this lawsuit. This year, new generation grew, that kind of trend reversed, but just slightly. But unfortunately, it wasn't enough to make up for the loss in supply from either resource retirements from thermal resources or accreditation impacts for resources like demand response. So when you take those things together, there was actually fewer megawatts offered into the 26-27 BRA as compared to 25-26, even though PJM is forecasting, significant load growth. So you can see now, like, this supply demand imbalance is as scarce as it's ever been for PJM. And they are under tremendous pressure to get new supply into the market just to sort of start addressing this. So that's just sort of a quick recap of kind of the market and what just happened with this auction. At this point, I want to hand it over to my colleague, Doug Matheson. Doug is going to help us kind of look forward and see what's coming down the pike for PJM in the coming years.
Great. Thanks, Dan. So if we go, perfect, on the next slide. So this next section, I'm going to be talking about, what can we expect for 27, 28, and then I got a few additional slides talking about what can we expect for kind of longer term horizon. But starting with 27, 28, let's first talk about what's changing and what's staying the same. So the administrative price cap and collar that Dan was just talking about, that was first in place for 26-27, that was a 2-year settlement with Governor Shapiro, so that's also going to be in place again for 27-28. Additionally, RMR units, those are also as a separate 2-year settlement, but it was more of a stopgap solution. They will continue to be priced at zero, price takers in the capacity auction. The goal there is for PJM to eventually work on a longer term solution of how to better treat the capacity value units that are on RMR agreements. But for 27-28, that'll still be in place. Third, as part of that same RMR filing, PJM will continue to be utilizing the CT, or the combustion turbine, as the reference resource in the VRR, or the variable resource requirement curve. That's the demand curve that's used in the capacity auction. Now, as for what's changing, the two key drivers are going to be supply and demand. And you probably picked this up from Dan's talk, but that's going to be a theme throughout this presentation, at least the capacity market part of it, with the real questions being when and by how much. So on the demand side, PJM's reliability requirement, Dan just talked about this, from 25-26 to 26-27, it increased by roughly 5.5 gigawatts. PJM that's increasing again by another 6 gigawatts from 26-27 to 27-28. And you can see that in the graph on the bottom here, the orange demand curve is kicked out further to the right. Now, on the supply side, and I'll cover this in a lot more detail in the next few slides, but given a lot of the current procurement and construction timeline issues, coupled with the fact that, as Dan alluded to earlier, much of the capacity that has cleared the queue has low ELCC ratings, kind of collectively on average. We wouldn't normally be expecting any significant volume of new supply to offer and clear in the 27-28 BRA, but we do have a potential expectation that with some of the results, some of the fallout of OBBA, that there's a chance that there's a bit of a sugar high, so to speak, with some solar projects potentially trying to come online sooner than they otherwise might have to try to capture the ITC. That being said, as Dan just talked about a couple minutes ago, despite those additional 4 gigawatts of UCAP from new supply and uprates that cleared in 26-27, the net impact of including also retirements and the sort of idiosyncrasies of how PJM does their ELCC modeling, it still resulted in a net 500 megawatt UCAP reduction relative to 25-26 cleared supply. So there's a decent chance that net supply changes, may not actually be a significant driver of where 27-28 clears. I'll say at the end of the day, a large part of the reason that this price cap and collar, this RMR price taking treatment was in place for just these 2 years, 26-27 and 27-28, was because PJM and a lot of stakeholders, both in the market and policymakers saw how frozen in place supply was largely expected to be for these 2 years, and therefore how it wouldn't exactly be fair to captive ratepayers to pay even higher capacity prices that Dan was just talking about, where it would have gone up to close to $390 a megawatt day during this sort of interim when supply largely has been physically incapable of responding in time to those high price signals. But the upshot, the kind of key takeaway here, and it may be fairly self-evident from the graph, but barring any significant changes in supply, we largely expect a similar outcome with pricing clearing near, if not at, that same administrative price cap in the 27-28 BRA. We can go to the next slide. So now if we want to, let's look to 28, 29 and beyond, right? So the two main drivers are going to be, surprise, surprise, supply and demand. So on this slide here, I'm going to focus on demand first, then I'll get into supply, and then I'll cover some additional potential drivers that are on the horizon. So on the demand side of the equation, and Dan mentioned this, got into it a bit, but it shouldn't be a surprise to anyone that's been following PJM specifically, or really the news generally, that forecasted load growth continues to skyrocket. And it's almost exclusively driven by projected data center build out in PJM to support the growth of AI. So as you can see in the chart on the left, last year in 2024, PJM's forecast showed peak load expected to reach about 170 gigawatts by 2030. But this year, in 2025, when they updated the load forecast, it's now showing 2030 at 190 gigawatts. So that's a 20 gigawatt jump in just a single forecast revision. And it's a 36 gigawatt increase from where we are roughly now today in 2025. One thing to keep in mind about these peak load graphs, though, is that there is a decent chance that these numbers could be somewhat inflated. It's hard to know the magnitude, but just like how it wasn't all that uncommon in the pre-order 2023 paradigm for generation project developers to submit multiple interconnection requests, for a single project to try to sort of hunt for the cheapest option. There have been reports that data center developers have been taking a similar approach in some instances on the load side, and that could be leading to the utilities potentially overstating their projections to PJM, and that could lead PJM projections to be potentially, again, inflated. That being said, we are, starting this past summer, we are starting to see the supply-demand crunch start to rear its head in real time. Back before the start of the 25-26 delivery year, back in early May, PJM projected a peak load of about 154 gigawatts for this summer, but less than 6 weeks later, that sort of like mid to late June heat wave, PJM saw its highest peak load in over a decade at 162 gigawatts. And furthermore, as you can see in the chart on the right, PJM has declared 11 emergencies so far in 2025. That's a 50% increase in emergencies being called in just 1 year relative to the prior 10 years combined. As a brief aside, one thing I'll note is that none of those 11 emergency declarations were treated as PAIs or performance assessment intervals due to a rule change back in 2023 coming out of Winter Storm Elliott. And so no penalties were assessed for underperformance, no bonus payments were paid out for overperformance because that rule change required both one, an administrative declaration of an emergency, of which, again, there were plenty this past summer, and two, a scarcity of reserves in real time. And that's similar to how PFP or pay for performance works in ISO New England. And because there was no scarcity of reserves, there were no actual penalties or bonus payments paid out. But the key takeaway here is that, we're seeing peak demand forecasts continue to balloon year after year after year. And even if there are some inflated numbers in those load forecasts, we are starting to see emergency conditions occur in real time at fairly unprecedented levels. So this trend, can't be ignored. If we can go to the next slide. So pivoting now to the supply side of the equation, PJM, and Dan talked about this a bit during his talk, and this is the same kind of pie chart from earlier, but PJM put out a fact sheet earlier this summer touting, how they had reduced the backlog in their transition cycles 1 and 2, TC1 and TC2, from what initially started at 200 gigawatts down to 63 gigawatts. So the inverse of that, of the 137 gigawatts that were processed, there's these 46 gigawatts that, now have ISAs in hand. Dan talked about this, they're, to quote PJM, ready to build. But again, with developers facing headwinds on permitting, siting, procurement, it's not clear when or even possibly if all of these, 46 gigawatts will come online. It's also worth noting, and again, Dan mentioned this too, but that due to the composition of those 46 gigawatts being primarily solar, wind, and storage, it translates to just 15 gigawatts of UCAP due to the low ELCC class ratings of those technologies. So of the 63 gigawatts that are still in the transition cycles, They, got that on the graph on the right there. They all are expected to be online or have projected in service dates through 2031. However, they're only expected to have a combined average ELCC of about 51%. And you can see that in the graph where the kind of lighter green represents the 63 gigawatts of nameplate, and the darker green area represents, how that gets cut down to just 32 gigawatts of UCAP. Now, on the retirement side of things, we saw just over 1 gigawatt of withdrawn generator deactivation requests in late 2024, and that was following the eye-popping results of the 25-26 BRA. And that implies that there were some, if not all of those, were economic retirement decisions being reversed. So if we extend that, kind of take it a step further, we could see that these improved market fundamentals, or even potentially more RMR agreements or 202C orders from the DOE, that could bend the curve further back on retirements. But as it stands right now, there are still, about 7 gigawatts of announced generator deactivation requests out there through 2031, and that's represented by the orange curve on the graph there. Now, sorry, we can stay on that slide one more minute. Now, the application deadline for PJM's first full cluster study, cycle number 1, that is going to be in late April 2026. I forget the exact date, but it's late April. And again, as Dan talked about this quite a bit, with PJM's queue having been frozen for several years now, it's fairly difficult to quantify how many projects will enter, what those technologies will be, the megawatt sizes, how quickly they're expected to come online, their projected in service dates. But when you at least add together everything, all the facts we do have, we've got the 15 gigawatts from the of UCAP from ready to build projects, 32 gigawatts left in TC1 and TC2. Subtract out the 7 gigawatts of announced retirements. That's only 40 gigawatts of net new UCAP on the supply side by 2031. And that's compared to, as I talked about in the previous slide, a forecasted increase of 36 gigawatts of peak load over that same, from this past summer through 2031. Excuse me. 1 second. And again, PJM's load forecasts keep growing year after year, and so they could continue to keep growing. But even if they don't, that still says nothing about what happens after 2031, sort of at the end of the runway that we have visibility into right now. Because between 2031 and 2040, PJM's load forecast from earlier this year is still projecting another 30 to 40 gigawatts of peak load increases. So all this is to say, market fundamentals currently point to no end in sight over at least the next 5 years, if not the next 15 years of significantly high pricing in PJM. Next slide, please. Sorry, I'm losing my voice a little bit. So we've covered how forecasted supply and demand are expected to kind of shake out over the next several years. Now let's spend a few minutes covering what else can we see on the horizon that could potentially move the needle on these two trends. So focusing on, I'm just going to do a quick time check. I've got plenty of time. Focusing on capacity market rule changes first. First off, as I previously mentioned, Dan talked about this too, that administrative price cap and collar goes away starting with the 28-29 BRA. And this means that while prices in the short term could very well start clearing higher, there is a chance that they're, for regression eventually, if that attracts, ample new supply. So one thing we really want to call out is that resource owners should strongly consider taking advantage of a previously approved rule change, again, coming out of Winter Storm Elliott, called CPQR, or Capacity Performance Quantifiable Risk. And that allows you to price in the risk of taking on, of the downside risk of penalties of taking on a capacity commitment in PJM. And that's in particular, very important now that solar, wind, and storage all have a must offer in the capacity market. Second, and this still hasn't passed, but there's actually a vote literally taking place, excuse me, this afternoon at the PJM Members Committee. There are still several competing proposals. Sorry, I should say there are several competing proposals out there to modify the VRR curve. That's the demand curve that's used in the capacity auction. It's part of it's called the quadrennial review. Every 4 years, they review kind of the inputs to that. And there's been changes in the past, or considerations in the past, to change from a combustion turbine to a combined cycle. But then there's concerns that could lead to price volatility. So we'll have to see where the vote shakes out today and what the PJM board actually, ultimately instructs PJM to do. But there's sort of a hope that whatever proposal passes does decrease price volatility from one year to the next. So moving on from capacity to the interconnection front, FERC recently approved changes to how PJM handles requests for what they call SIS, or surplus interconnection service. Those rules had previously effectively precluded adding technologies like storage to projects that have existing capacity right headrooms or CIR headroom, that had already been studied, but and that's primarily going to be solar and wind. But going forward, with PJM making SIS far easier, and with as a result of OBBA, the retention of ITCs for storage, we do expect to see increased interest in co-locating storage with both existing and planned solar and wind, in particular in PJM. Continuing on the interconnection related reforms, FERC initially rejected PJM's initial proposal to make it more efficient to transfer CIRs, or capacity interconnection rights, from retiring projects, primarily thermal, to new projects that are trying to be built at the exact same POI. And the whole point of that is it negates the need to be, go through the full queue and be fully studied. But again, FERC rejected that. However, PJM does plan to refile that proposal in the very near future with changes that they expect to accommodate FERC's concerns, which were namely, they will now require the replacing resource achieve COD within 3 to 4 years, or risk forfeiting those CIRs and needing to enter the queue fully. Finally, there are two other proposals to keep an eye on. I'd say even though they're fairly early stage, they're going to move very quickly. So first, as sort of a fail-safe solution against load increasing to unsustainable or unreliable levels, PJM recently proposed this idea of NCBL, or non-capacity backed load, with a goal of potentially having in place in time for the 28-29 PRA scheduled for next June 2026. I'll say, feel free to look this up online, for a lot more details, as there were well over 200 pages of comments submitted by stakeholders, by various stakeholders to PJM. There's been a number of industry news articles on this, Utility Dive and whatnot. But the nearest analogy that I can come up with is PJM is kind of wanting to take the approach of airlines when they overbook flights. They'll ask for volunteers first when they're overbooked, have too much demand relative to available supply. But then if they don't get enough volunteers, they're going to start bumping passengers, or in this case, new large loads that are over 50 megawatts, which, as you can imagine, is going to be predominantly these AI data centers. Now I'll say, regular rotating blackouts obviously aren't very attractive as a type of loads that aim for 99.999% uptime. So you can probably imagine the tenor of the comments to this proposal. But again, from PJM's perspective, at least, it's intended to be sort of this equitable, fail-safe solution to maintain grid reliability, with blackouts being targeted at newest large loads that are arguably causing the problem, because the alternative would be widespread rotating outages. But I will say quickly, even if a PJM solution on this doesn't come to fruition, or if it takes longer to develop, the states that are most impacted by these new large loads, they aren't really sitting idly by either. That's largely due to concerns about cost shifting to existing ratepayers. So earlier this year, in Ohio, the Public Utility Commission, they approved a tariff with AEP, specifically for data centers, that forces them to pay a sizable portion of their share of power and T&D costs for the first 15 years, even if they don't get built, or if they are built, but eventually shut down early. And Dominion recently approved a nearly identical framework in Virginia, as Dan mentioned earlier, Data Center Alley. So actions like this, could slow down some of the load growth, or at least hopefully shake out any inflated numbers in PJM's load forecasts. Lastly, in the past, PJM had considered moving to a subannual market, similar to what New York ISO and MISO have, and what ISO New England is currently working on. And they're now restarting those discussions with the hope that breaking out accreditation seasonally will lead to a situation where, in theory, the whole is greater than the sum of the parts. With PJM providing separate price signals based on available seasonal supply, relative to, versus the seasonal load, as opposed to what they do right now, which is taking kind of the lowest common denominator, knocking all resources down to their annual availability based on annual peak loads. So in summary, if all the supply and demand trends that Dan and I just covered weren't enough to make your head spin, hold on, because there's a lot more on the horizon. Next slide. Sorry, can we get the next slide? Team's freezing up, maybe.
Should be good. Showing the regulation market redesign. Is that where we're?
Oh yeah, sorry, just moved for me. Apologies.
Cool.
All right, so pivoting away from the capacity market, Dan mentioned this earlier. We want to provide an update on another big change in PJM that's taking effect. Not even a week from now. It's on October 1st. So last summer, FERC approved a proposal from PJM to redesign its regulation market in two distinct phases. Again, phase one, October 1st, 2025. Phase two will be October 1st, 2026. So for some quick background, quick context here, there were two main issues that led PJM to want to redesign the regulation market. The first of those is very, very esoteric, but I'll give a brief overview of it. It relied on this complicated concept called the benefits factor, and that was developed because it was meant to sort of properly commit and price the traditional regulation product, Reg A, which was designed and kind of meant for slower ramping, sustained output resources, thermal resources primarily, versus Reg D, which was meant for fast ramping, duration limited resources like batteries. And again, in short, because the details are very in the weeds, the usefulness of that benefits factor had largely run its course. The second main issue that led them to want to redesign regulation was that, similar to a lot of what we were talking about on the capacity side, PJM was looking to its interconnection queue and saw that it was predominantly solar and wind resources coming online. And it realized that they need to be able to provide a price signal that properly reflects real-time system needs for regulating up versus down. And the current price, single price for a bi-directional product wasn't going to cut it. And similarly, moving the clearing interval to be every 30 minutes instead of every hour, that gives PJM that much more additional flexibility, basically to adjust to the realities of intermittent power. So I'd say, for battery owners and developers, there are a few key takeaways regarding these changes. First, the new combined signal is faster than the old Reg A signal, but slower than Reg D. So a battery that has been successfully participating in Reg D, or one that's been designed to and is in development or under construction but not yet in the market, should be more than able to be successful with the new product. I'd also add that, as a quick tangent, because this new signal is faster, there's a decent chance that some of the historically marginally performing Reg A thermal units might not be able to provide as much regulation capacity going forward, and that could be a boon to pricing, kind of all else equal. Second, while Reg D was technically not an energy neutral signal to begin with, in practice it was pretty close. So if you look at the graph on the bottom left there at the yellow series, you can see that the Reg D signal is averaging pretty close to the zero line, implying it's nearly energy neutral. But if you look at the green line, you'll see that the new signal will inherently not be energy neutral, coming close to the zero line only once, only very briefly, kind of over that 1 hour period. So it'll be pretty critical to manage battery SOC in the new regulation market. And again, that importance will only continue when phase two goes live about a year from now, which is when PJM will officially be moving from a single bidirectional product to separate Reg up and Reg down products, similar to what ERCOT has. Next slide, please. Okay, so pivoting away from what's happening in the PJM markets, let's talk about what's cooking in some of the PJM states for storage incentives. So starting with New Jersey, earlier this summer, the New Jersey BPU, the Board of Public Utilities, they released an order establishing what's called the Garden State Energy Storage Program, or GSESP. That stems from a law passed several years ago, back in 2018, which had mandated 2 gigawatts of storage in New Jersey by 2030. Now, between 1,500 to 1,800 megawatts of that target is now going to be effectively directly covered by GSESP. So the program split into 3 phases. Phase 1 is focused on transmission scale storage, Phase 2 on distribution, and Phase 3 would be adding a performance-based incentive for transmission scale. So Phase 1, it consists of competitively bid, fixed dollar per megawatt year type incentives that would be paid out annually, and it would be split up into 2 tranches. So tranche 1 bids were actually due a little over a month ago. The BPU is aiming to procure, minimum of 350 up to 750 megawatts, kind of funding permitting, and we should see awards announced next month. Initially, sort of how they define transmission scale was explicitly transmission interconnected, right? So typically 69 kV or higher. However, just a little over a month or so ago, the Governor Murphy in New Jersey signed a bill into law that came out again after the BPU order, so there wasn't enough time to react. That redefined transmission scale as 5 megawatts or greater. So that's why the minimum requirements for the second tranche of Phase 1 is different from the first tranche. Additionally, the minimum interconnection requirements for the second tranche are also slightly more loose, allowing for projects to only have paid their what PJM calls decision point 1, readiness deposit, whereas the first tranche you actually had to have a signed ISA in hand. The RFP for that second tranche is expected to be released early next year, Q1, maybe into early Q2. Bids would be due late spring, early summer. But the details haven't been fully ironed out yet by the BPU. There'll be another order coming on that. And then any Phase 1 any tranche 1 capacity not procured out of the gate will be included up to the full 1,000 megawatt allocation in the second tranche. Now, I said I was pivoting away from PJM, but to quickly tie this back to some of the updates we gave in PJM, because of these stringent minimum interconnection requirements for Phase 1 for transmission scale, we do expect some developers may focus on adding storage to existing solar projects, or maybe not existing and operating, but at least, again, under development, under construction, but have signed ISAs, because given what I discussed with PJM's reforms to the surplus interconnection service or SIS process. Moving now, looking to Phase 2, which is the DG portion of GSESP. This is still in fairly early planning stages, but the BPU did recently release guidance on its thoughts, where they're thinking about creating a block style kind of annual fixed annual incentive program that would be administered by the BPU, plus a performance-based incentive that would be administered by the EDCs. And initial reactions that it probably is going to look somewhat similar to Connected Solutions that's available in Mass, Rhode Island, and Connecticut. But again, more details are coming on that. For Phase 3, there are very little details here, very few. And honestly, it may not even come to fruition, but the general idea will be to possibly layer on a performance-based incentive for transmission scale storage projects that would be tied to emissions reductions, somewhat akin to the Clean Peak Standard program that's available in Massachusetts. So few key things for you to keep in mind, if you're interested in GSESP. First off, project applying for any of these incentives can't have come online prior to the date of the BPU order back in June. Second, projects for the first tranche need to have a planned COD roughly within 3 years of being awarded. And again, we don't have the full details yet, but we'd expect a similar timeline for tranche 2. Third, in order to receive full compensation for the annual, fixed dollar per megawatt year incentive, projects have to demonstrate that they were available at least 90% of the hours of the year. Anything above 90%, you're paid in full. Anything below 90% availability, there's a pro rata reduction. So you can kind of think of it as a 90% availability cliff. Fourth, if you are going to try to take advantage of PJM's SIS reforms that I was referring to, it's important to note that storage co-located with PV can't be receiving funding from any other Jersey state programs. Lastly, we don't yet know incentive levels or what incentive levels will be competitive for Phase 1, or kind of what the incentive levels for the block style or performance-based for Phase 2 for DG will exactly look like. But a key fact, at least to help you, kind of gauge where the support levels may land, is that the state allocated a minimum of $60 million per year to fund GSESP. Go to the next slide. All right, last one, quick time check. All right, running out of time, so I'll try to get through this one. So like I said, New Jersey is, the furthest along of all the states in developing large, kind of concrete compensation opportunities to incentivize storage build out. But let's talk about Maryland next, which is, the next furthest along. So 2 years ago, Maryland passed its own law setting a storage target of 3 gigawatts by mid-2034. That's going to be, the goal there is to have that to be met by incremental targets kind of spread out every 3 years. Ever since then, a storage working group in the state had been meeting and working to try to develop opportunities to try to meet those targets. But the process had largely been kind of stuck in a rut, had kind of stalled out a little bit. And, ever since the kind of looming resource adequacy crisis, issue in PJM reared its head, Dan mentioned this with the 25-26 BRA, the BGE zone, the Baltimore area zone cleared significantly higher than the rest of PJM. The Maryland legislature passed a second bill called the Next Generation Act that was signed into law back in May by Governor Moore with a goal of having the PSC put in place kind of targeted near-term opportunities to start building momentum faster towards that 3 gigawatt goal. So it's worth calling out this new law, the Next Generation Act. It only covers about 60% of the 3 gigawatt target. So we do expect to see more down the road, but for now, it's still a very sizable opportunity. So first off, transmission connected projects will be able to bid on 2 competitive solicitations over the next 2 years for similar to New Jersey, 15-year fixed incentives. They'll be split up into 800 megawatt procurements each. Projects will get to keep any energy and ancillary service revenues, but any capacity revenues received by PJM have to get refunded to the PSC. So you should essentially think of this as, what do you need the capacity revenues to be for your project for the first 15 years? Requirements-wise, we'll see more when that first RFP is released early next year, but at a minimum, we do know that projects need to come online within 2 years. So again, similar to New Jersey, we do expect to see developer interest in PJM's revised SIS rules to co-locate storage with solar, and potentially even the enhanced CIR transfer process, given some of the larger thermal retirements that are scheduled in Maryland. On the distribution front, the opportunity is a lot smaller than New Jersey, only 150 megawatts, and the details are admittedly still a little bit murky, as the EDCs don't have to file their plans with the PSC until November 1st. So we'll find out more in a few months, but we do know that at least 30% of the 150 megawatts need to be third-party owned. The rest will be utility owned. And additionally, while we could see competitive procurements here too, similar to transmission connected, we do know that there's been chatter of moving in the longer term to what's being called sort of a revenue stream layer framework. So it's very similar to value stacking VETR in New York. So it is possible that the EDCs include that as part of their November 1st filing, but potentially a next year update. Again, worth keeping in mind, only 60% of the 3 gigawatt target is covered by this second law, so that still leaves 1.2 gigawatts to go. On the DG front, given how successful VETR's been, on the transmission front, hopefully we see more procurements. But long and short of it is, we would not be surprised if there's more action to expand opportunities for storage in Maryland over the next 2 years. Next slide. I think we're on Q&A now. We made it.
We made it indeed. So Doug and Dan, thank you. Obviously, there are never any boring times in the power market, but these are particularly exciting times to be a generator, user, or enthusiast about power in PJM. We've got a few questions that have come in both in advance and over the course of this webinar. I'm going to go from the top here. And we will not have time to get to all of them. So if you have one in and we don't get to you, I promise we will follow up with you directly. But I'll jump right into it. And let's put this one to Dan. So since prices just hit the cap, is PJM considering extending the price cap for the auction into future years?
Yeah, that's a great question. I mean, so the short answer is no, PJM is not, currently planning to do that. But as Doug mentioned, even today, there's a vote going on related to the VRR curve, right? And that's the demand curve. And those changes could potentially add some stability to how prices clear. We saw that MISO made a big change to their demand curve in the capacity market in the past year. But the settlement that was put in place, the lawsuit that was filed, only applied to 26, 27, 27, 28. So there is no lawsuit or settlement in effect beyond 27, 28. Whether that gets extended, I don't have the crystal ball, but as I said earlier, the political pressure on PJM right now is not relenting at all. And so if we continue to see high prices, I would not be surprised if there was more pressure, more lawsuits potentially for PJM to take some kind of action.
Got it. All right. Thanks, Dan. So this one, maybe I'll put it to Doug. So will DG batteries participating in the New Jersey incentive be required to participate in the PJM market?
Got it. Yeah, so again, the details on phase 2 of GSESP are still pretty early stage. The BPU only kind of put out sort of indicative thoughts recently. But I would say that our understanding is technically probably not required to participate in PJM, but again, they have not finalized the order there. I would say though that even if with the finalized order they are not PJM wholesale participation is not explicitly required, we still would encourage you plan to participate in the PJM market to access additional revenue streams, because the incentive levels they likely won't be robust enough to fully cover the cost of your project.
Cool. This one's also for Doug. Do all of the emergencies PJM had this summer suggest there could be more scarcity events in coming years? So I think that's looking to the potential for penalty or revenue events associated with scarcity.
Yep, and I think I touched on this when I was kind of talking about how we're starting to see this show up in real time. None of those emergency conditions this past summer technically triggered PAIs. But I would say though that if the load growth that is forecasted persists and supply can't catch up, again, which is sort of like kind of our working thesis here over the next several years, then yes, that trend does suggest that we could start to see more actual PAIs, performance assessment intervals, and therefore potential penalties, potential bonus payments in the coming years. And again, that's why using that standalone CPQR capacity performance quantifiable risk option, so that you don't have to clear a UCAP a capacity commitment below your sort of expected value of those penalties and bonus payments is pretty key in the long run.
Got it. Okay. Dan, this one's for you. If my project missed the qualification window for the next BRA, can it participate in the incremental auction?
Yeah, okay, good question. Yeah, so short story is yes, it can. Kind of the caveat is, if you're bringing up, project into the market and it's a planned project that's not yet built, you have the option to participate, but not the requirement. If you don't submit what's called a notice of intent, an NOI, and you don't participate in the BRA, then you're open to participate in the incremental auctions. The thing to note, though, is that the qualification requirements are stricter in terms of where you are in the interconnection process. To participate in an incremental auction, you have to have either a signed interconnection or a signed WAMPA if you're at the DG scale. Whereas to participate in the BRA as a planned project, you only have to have a system impact study. So yes, you can, but again, you have to keep note of the fact that the requirements to qualify are a bit stricter.
Gotcha. So Doug, would the non-capacity load proposal mitigate the impact on BRA prices from new data centers being built?
Got it. I'm assuming that question meant the non-capacity backed load and CBL. So yeah, that's what it sounds like. I would say, in theory, based on how everyone, all suppliers offer into an auction, it could, but in practice, very likely not. If PJM, the only reason they would use, or at least again, this is a proposal, it's not set in stone yet, but it's probably going to develop pretty quickly over the next several months. But if they do have to sort of like pull the trigger and use this NCBL option in a capacity auction, it's because they're forecasting a shortfall, right? And so pricing with a true shortfall that's sort of uncorrected via NCBL would clear at the cap. If PJM administratively, reduces that shortfall to zero by saying, hey, you X gigawatts of new load do not have capacity and therefore treat it as NCBL, pricing very likely will still clear at the cap, right?
Yeah. We are at time, but I'm going to do one last lightning round question for Dan. Do you expect the DOE to continue to delay the retirement dates of thermal resources?
Yeah, sort of, I wish I had the crystal ball on that one. Whether they can, they certainly have the authority to. Lots of states have been pushing back on this and state regulators, but DOE has the authority to. So, wouldn't be shocked if they continue to maybe kind of modestly expand what they've done so far. I don't think we'll see a massive, kind of push to delay all retirements. And as Doug mentioned, these high prices might kind of, have the effect of delaying or reversing some of the retirements that have already been announced.
Well, you heard it here first, folks. Dan, Doug, to all of our attendees, I know we've dropped off a bit as we've hit the top of the hour here, but thank you all for joining us. I'm going to close out the webinar now, and we will see you next time.